Hello and welcome. You're with us here on Business Today. I'm Abha Bukaya. Here are the headlines. Amid global volatility, Indian economy continues to be resilient, says RBI Governor Shaktikanta Das, announces a 25 basis point hike in repo rate while retaining stance of withdrawing accommodation. Reserve Bank hikes interest rates yet again by 25 basis points, the highest in 4 years. The rate hike to directly impact borrowing, making home loans costlier. Join us over the next couple of minutes to decode the consumer impact and the way ahead. The infrastructure conglomerate GVK's Vice Chairman GV Sanjay Reddy rebuts Rahul Gandhi, says there was absolutely no pressure from the Adani Group to sell Mumbai Airport, adds that the decision was made on their own volition, citing that the company needs to clear debt from their balance sheet. Street Digest, 25 basis point hike from RBI, benchmarks close in the green. Nifty with gains of nearly 1%, Sensex up 380 points. Prices continue to be the main concern for the Reserve Bank of India as it hiked repo rates today for an unprecedented 6th time in 9 months. According to the central bank, inflation remains sticky, which is a big problem. RBI also announced a GDP growth estimate for 23-24, which is slightly lower than the estimate announced in the economic survey just 9 days ago.
The world is looking to India, now at the helm of G20, to energize global partnership in several critical areas. This reminds me of what Mahatma Gandhi had said. I do believe, and I quote, I do believe that India can make a lasting contribution to the peace and solid progress of the world, unquote.
An optimistic beginning to the RBI governor's statement on the first monetary policy after the union budget, soon followed by concerns over the one economic indicator religiously tracked by policymakers at the Reserve Bank of India.
Headline inflation has moderated with negative momentum in November and December. We need to see a decisive moderation in inflation. We have to remain unwavering in our commitment to bring down CPI headline inflation. Thus, monetary policy has to be tailored to ensuring a durable disinflation process. A rate hike of 25 basis points is therefore considered as appropriate at the current juncture.
According to the RBI, inflation this fiscal is expected at 6.5%, much above the target of 4%. For 2023-24, the central bank has estimated a figure of 5.3%, which still is much higher than the RBI comfort level. This sustained inflation is the big reason RBI has decided to continue with its task of withdrawing excess liquidity from the market. The RBI hiked repo rate by another 25 basis points to a 4.5-year high of 6.5%. The decision steered in part by global outlook.
The global economic outlook does not look as grim now as it did a few months ago. Growth prospects in major economies have improved, while inflation is on a descent, though inflation still remains well above the target in major economies.
The repo rate hike adds to the fastest ever escalation in cost of money. The hikes began in May 2022 when repo rate was at 4%. 6 hikes later, the benchmark rate is at 6.5%. Though the pace of hikes has slackened from 0.5 percentage point to 35 basis points in the December policy to 0.25 point now. The sustained rate hikes and the fight against inflation may have compromised on economic growth though. The RBI has forecast a growth rate of 6.4% in 2023-24, which is lower than what the economic survey projected just 9 days ago. It is also much lower than the 7% GDP growth expected in 2022-23.
According to our surveys, manufacturing, services and infrastructure sector firms are optimistic about the business outlook. On the other hand, protracted geopolitical tensions, tightening global financial conditions and slowing external demand may continue as downside risks to domestic output.
According to the governor, additional capacities are being created in the steel, cement, mining and chemicals sector. Higher Rabi output is expected to cool food prices. The central bank is seeing sustained demand in contact-based services, and the massive capex push by the government is keeping money flowing in the system. Interestingly, the US Federal Reserve had also slowed the pace of its rate hikes, boosting hope that the cycle could end soon globally. Bureau Report, Business Today Television.
Some other big decisions have also been taken by the RBI today. These include lending and borrowing of government securities and restoration of the GSEC market timings to pre-pandemic levels. Another big move is to allow foreign tourists from G20 countries the use of UPI.
The next announcement, the next measure relates to extending UPI for inbound travelers to India. UPI has become hugely popular for retail digital payments in India. It's now proposed to permit all inbound travelers to India to use UPI for their merchant payments, that is P2M, while they're in the country. To begin with, this facility will be extended to travelers from G20 countries arriving at select international airports. The Reserve Bank of India will launch a pilot project on QR code-based coin vending machine in 12 cities. These vending machines will dispense coins against debit to customers' account using UPI instead of physical tendering of bank notes. It has now been decided to restore market hours for the government securities market to the pre-pandemic timing of 9 a.m. to 5 p.m. Moreover, as part of our ongoing endeavor to further develop the government securities market, we propose to permit lending and borrowing of GSECs. This will provide investors with an avenue to deploy their idle securities, enhance portfolio returns, and facilitate wider participation. It is now proposed to expand the scope of trades by, first, providing insurance facility for invoice financing, second, permitting all entities and institutions to undertaking factoring business to participate as financiers in trades, and third, permitting rediscounting of invoices, that is, developing a secondary market in trades. These measures are expected to improve the cash flows of the MSMEs.
As the RBI hints at more rate hikes on the cards, meanwhile, BTTV Sakshi Batra spoke to Vivek Kumar, economist, Quant Eco, and Siddharth Sanyal, chief economist, Bandhan Bank, to decode the first RBI policy post the FM's Saptarishi budget.
So what's the rationale that you've thought, you've deferred and, you've inferred from the statement made right there, that why does the governor really think that it is likely to remain this withdrawal of accommodation for some more time to come?
So I think that's a good question, because there are two implications for this. One is what's happening on the global side. In the last 2 odd weeks, in fact, I would say last 4 odd weeks, there are subtle signs on the global picture which are comforting. So China economy reopened, that's a positive sign for global economy. And the US, at least, while yes, there was a step down in terms of monetary policy rate hike from 50 basis points to 25 basis points in February. But the recent numbers which are coming out from US again reiterate the point that the likelihood of Federal Reserve staying higher for longer is something which could turn out to be the case in 2023. Vis-a-vis markets' expectation of a rate cut. So the markets are expecting anywhere between a 25 to 50 basis point rate cut in 2023 from the US Federal Reserve.
For how long would you expect this prolonged pause to be before we can see a rate cycle reversal?
No, I think that's pretty difficult to say at this stage. But typically, if you see the Indian central banking style, it's not. I mean, many a times these days we get to hear that how much the US will be hiking at this moment and how quickly the US will start cutting within a few months. That's typically not the style an emerging market central banker would like to follow. Most probably, if RBI paused a little earlier than the Fed in April, they will possibly try to extend their pause as long as possible,
Okay.
ideally beyond the calendar year at least.
Okay. And in terms of your own growth projections, does it marry with what the projections have been given by the RBI?
We are a bit more conservative. We are in the sub 6% zone compared to RBI 6.4.
Okay. And on the inflation?
For the next financial year, that we mean.
Okay. For the next financial year, that's FY24, sub 6% growth is what you're penciling in on inflation?
So in inflation, the governor said that an average inflation of 5.6% for the year. We are in a similar zone. We do talk about something of about 5.5% vicinity for the next financial year. But I think on the inflation side, the risks are more evenly balanced and risks are more pronounced than anything else. So basically, the uncertainty quotient on the inflation front is very, very high.
One of the biggest impacts of the RBI decision today will be a rise in the EMIs that you pay on home, auto and personal loans. There will be a corresponding rise in interest rates offered by banks of fixed deposits as well. Interestingly, according to the date in the RBI governor's speech this morning, while repo rates rose by 225 basis points between May and December, average interest rates on loans were up 137 basis points and on deposits were up a massive 213 basis points. For more on this, we've got Tina Jain-Kaushal joining us, editor personal finance of the Business Day magazine. Tina, what kind of impact will the rate rise have on those with home loans?
Thanks, Abha. Tough time continues for home loan borrowers as the Reserve Bank of India has increased repo rate from 6.25% to 6.50% today. This is the sixth hike since May 2022 and the collective jump in repo rate has been 225 basis points. This steep rise in repo rate will definitely have an impact on your home loan EMIs. For example, if you have taken a home loan of 30 lakh, your EMI has jumped up from rupees 22,757 to rupees 27,410. Similarly, for a loan of rupees 50 lakh, your EMI has jumped up by almost rupees from 37,929 to 45,696. Hence, overall, your EMIs have jumped up by 20% over the period of just 9 months.
Tina, the RBI governor's speech shows the pass-through to deposits has been higher. Does the latest hike in repo rates mean that we can expect a rise in small savings rates as well?
Yes, Abha, after the increase in repo rates, small saving rates are expected to go up. This is because small saving rates are dependent on the bond yields, which have gone up today after the increase in repo rate. And the small saving rates were last revised in December 2022. With this hike, the deposits are going to become attractive. And considering the fact that small saving schemes have direct competition with deposit, they have to the rates have to be risen to make them attractive in comparison with the deposits.
All right, thanks so much for joining us, Tina. Green across the screen today on Dalal Street, 150-point uptick on the Nifty, closing near the day's high to settle above 17,800 levels. The Sensex soared over 370 points to close well above that 60,600 mark. Broader markets also mirrored gains from their larger peers. The Adani pack shining bright. Adani Enterprises closed with gains of over 20%, while Ports was up 9% at close. Among other gainers, we had some life insurers, HDFC Life and SBI Life. Bajaj Finance also ended the day in the green with nearly 3%. On the losing end, we had names like L&T, Eicher Motors, Bharti Airtel, Hero Moto and Axis Bank, all closing with cuts of over 1%. It was the new age tech stocks that were rallying in trade today. My colleague Sakshi Batra joining us to explain the legs of this rally and what's triggering this uptrend. Sakshi?
Well, that's right, Abha. The new age tech stocks were on a roll today with Paytm, Zomato clocking in double-digit gains of 10 to 15 odd percent. Nykaa and PB Fintech also rising over 6% each. Now, let's first try and understand what is really behind this sharp up move today on these stocks. Now, after a year full of underperformance that we've seen on these new age tech stocks on the D Street, them losing about 40 to 70% of their market value, is there something that's sustainably changing? First up on Paytm. Well, the shares of 197 Communications, the parent company of Paytm, rallied for the third straight session today, and that's after the December quarterly results and after Paytm really posted the first ever quarterly operating profit as a listed firm, and the company's losses also narrowing during Q3. Now further, major global brokerages have also raised the target price of the stock. Macquarie, for example, has double upgraded Paytm stock to outperform from an underperform rating. Now Paytm has also positively surprised on the distribution of the financial services revenue by a wide margin. It has also managed to control the overall expenses and the charges that have been looked at positively by the analyst community. Shares of Zomato surged sharply ahead of its earnings as well on the hopes of improved earnings coming about also for Q3. Adding to that, global research and broking firm CLSA Asia Pacific Markets positive growth outlook and the expectations of a strong upside really potential in the stock. They've also lifted the investor sentiment. CLSA Asia Pacific Markets has in fact raised Zomato's earnings estimate for the next 2 financial years by about 4 to 8% due to the company's improved focus on profitability as well. The broking firm has also given a buy rating to the stock along with a target price that is now at 70, which translates to over a 40% potential upside from the time that the company had given out this report. Now Nykaa and PB Fintech were the other movers in trade today, over 6% gains ahead of the Q3 earnings. While these may be looked at as promising signs for these new age tech stocks, the moot question now is on the investor's mind that whether the worst is over for these new age tech stocks.
The big question. Thanks for that, Sakshi. Well, staying with some more stock-specific action, the Adani pack showing a recovery trend. Adani Enterprises rallied as much as 20%, ending the session at the day's high. Adani Ports was up nearly 9%. Adani Wilmar, Transmission and Power all locked at upper circuit. Barring Adani Green and Total, the only 2 stocks from the conglomerate that closed in the red today. Well, the RBI has reiterated that the Indian banking system remains unaffected by the Adani controversy. Just a couple of hours ago, he announced a hike in repo rates, and the governor was also fielding questions on the Adani issue. This is what he had to say.
We have issued a press release on last Friday. Nothing more to add to that. Individual cases and their numbers, as you are aware, we do not discuss in the public domain. Having said that, let me mention in addition, because so many questions are being raised in the public domain, in the last 3 to 4 years, the Reserve Bank has taken a number of steps to strengthen the resilience of Indian banks. We have come out with clear guidelines to regulate the governance in Indian banks. We have issued guidelines about the functioning of the audit committees. We have issued guidelines for the functioning of the risk management committees. We have now made it mandatory for appointment of chief risk officer in banks. We have also made it mandatory for appointment of chief compliance officers of the banks, and we have given through our regulations the desired level of autonomy to the chief risk officer and the chief compliance officer with regard to his functioning within the bank. The chief risk officer, for example, reports directly to the audit committee. And there are so many other regulations which I am not going into. We have also rationalized in the last 2 years the large exposure norms, and all that I would like to add at this point of time that the Indian banking sector, including the the NBFC sector, since you referred to a couple of them, the Indian banking sector and the NBFC sector continue to be resilient and strong.
Zoom and eBay are the latest tech companies to announce layoffs affecting roughly 2,000 people. They join the likes of Dell, who earlier this week announced 6,000 job cuts. This takes the total number of layoffs in big tech to more than 150,000 workers in recent months. But what's driving this firing frenzy, and when will it come to an end? Business Today's Akanksha Chaturvedi brings us more. Akanksha, do we have numbers on the extent of the layoffs? How many people have been impacted in the last few days?
Well, that's right, Abha. The latest slew of layoffs have impacted people at eBay as well as at Zoom. Zoom laid off around 1,300 people and eBay let go of 500 people. Just a couple of days ago, Dell also announced layoffs. Dell let go of 6,500 people. And this contagion of layoffs has been spreading last month. Amazon announced layoffs. They'll be extending to 8,000 more people, which means a total of 18,000 people would be laid off at Amazon. Furthermore, Google also announced that they would be letting go of 12,000 people. So far, when you count all the companies and all the people who've been let go, the figure sits at around 1,50,000 people. A little over 1,50,000 people have lost their jobs in the latest tech layoffs, which has hit the industry in the past few months.
Akanksha, what are some of the reasons why these tech giants, which were otherwise dream employers of techies, are firing so many employees?
So we've been able to narrow down the reasons behind these tech layoffs, and we've concluded that there are broadly 5 main reasons why these tech companies are, going through this mass layoff exercise. And the first reason is the COVID overhiring. And during the COVID-19 pandemic, we saw that the product needs of companies had evolved overnight. Like, for example, Google Meet, which allowed only a selected number of people which could, who could go on the platform and participate in video conferencing meetings. They had to, transform the product overnight to let more participants in meetings. Similar things happened with WhatsApp's video conferencing platform, and other companies also, this is just one example. And there are other tech companies, who hired more people because their products had to be changed in the COVID-19 world, in the world which was going through the pandemic. Another reason behind this has been the pressure from investors, and investors as well as all these people, angel investors in companies, fund managers. They've been pressurizing these companies to, let go of people so that they can brace for the upcoming slowdown.
All right, Akanksha, we'll leave it there. Thanks so much for taking us through all of the factors at play. That's all we have time for on the show tonight. Thanks so much for watching.